to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. So wanted to start by looking at a few trades that we've been talking about recently. One of them was in Amazon, and we did ride that trade over last week, over the last 5 days. And that trade panned out. And I want to go back and do a little rinse and repeat. I think I want to do a short call spread in Amazon. I'm not as bullish to the upside, but I do think that there's a good level of support a little bit down. And we're going to do a shorter term short call or short put spread, bullish put spread in Amazon for the week. So we're going to look at a speculative using weeklies short put spread. And then want to look at BlackRock. We do have a longer term position in BlackRock and where that underlying stock is currently trading. We've got a little bit of a movement to the upside. It's actually working out fairly well in that we did a long diagonal trade. In other words, we bought the longer term option and we sold the shorter term option against it. Now, in my book, I reference this as the fig leaf, which implies that we're buying a deep in the money option contract as a surrogate for owning the stock, and then we're selling a shorter term call against it. And I always like to say that you're kind of covered in that you don't own the stock, so it's not as simple of a trade as just doing a good old cover call. But you own something that acts like the stocks. The downside is that if you get assigned, you need to give them stock, not your option contract. So I've always kind of said that you're kind of covered as far as the brokerage firm is concerned. You're covered. The more, I guess, down in the day on the trading floor, they called it a diagonal trade. And the reason why they called it a diagonal trade is that if you were quoting it, if somebody came down to the floor with both legs of the trade, they would basically have to look at the board diagonally because of the way the expirations were laid out to get a quote on the board. And hence that's where the term vertical comes from, horizontal, with just flat out time spreads. It's all about the way that you have to look at the quote board in order to quote that strategy. So in BLK, let's show the chart right now. Let's go to the Tradier Pro software. And you'll see, and I'm going to zoom in this area, but strong strength in BLK. It still trades at a decent valuation. If you look at the price or the earnings and the ex-dividend date, so the earnings per share, we are a little bit inflated, but not bad relative to what they have going on. They got a lot of mergers and acquisitions that are going on. They've said that they have strong balance sheets. They are looking to be after their last earnings report, they are looking to become get more deals done and bring in more capital. They manage a lot of capital at this point in time. And so to me, it's a strong candidate for a covered call or for the fig leaf in this scenario, in that the stock is $1,000. It's very expensive to try to buy 100 shares of it. We've had a strong move up and then some consolidation. So still looking for some movement to the upside. Here is the 20-day moving average. And we've kind of gotten that recently, right? So since we put the trade on, we were right back here when we first put the trade on. We've had a little bit of choppiness, and it's kind of ran to the upside. We do want it to come out and eventually break out and bust through this 168 level. That would be the ideal scenario in BlackRock. And we still have 200 plus days in our option contract. So that's where the position is at, and we'll leave it there. The trade is profitable at this point in time with this little bit of a movement up. But this is definitely a trade that we have to manage. The downside of the BlackRock position is that we're deep in the money going further out in time, and the bid-ask spread is fairly wide on the one option contract that we have bought. Now, the new trade that I want to put on this week is I'm going to go back to the wheel, or go back to the wheel. And that's kind of, I guess, where my mind is at, thinking of the wheel strategy. But with Amazon, I'm scared to get long anymore because we talked about getting long way down here, at 207 in the breakout. And we didn't do the trade on the initial breakout. I mentioned it. And then once we got up to this level and we're pushing towards the new high, we decided to get long a long call spread last week. And here we have the breakout and a strong breakout. So now, in my mind, if we come back to these levels, there's going to be some decent support. But I do think the move has been too parabolic to try to get long again. And we're flat today on the underlying stock. But I kind of like the way that this has been trading. And because it's Options Guy TV and we want to kind of look at some trades, I think this would be a candidate for a 45-day short put spread, which is something that I would usually do in the SPY or the SPX. And that is, I think it's a real solid range to be trading short options that you would like to manage, and that if the market comes against you, the time premium protects you. If the market rolls up, you're just in this nice range of time decay. I don't want to approach it this way on Amazon based off of this chart. I want to do a shorter term trade, so we're just going to use the weeklies. We're going to go out 11 days, and we're just going to sell some premium on it, which also means that we have less opportunity to manage it. If this market goes against us and we decide that we want to get out of the trade, well, we're probably just going to close it. We're not going to necessarily manage the trade. So to me, this is a lot more speculation on the trade. I want to go about a 1 standard deviation out of the money. And let's start by looking at the December 20th expiration date here. Inside the Tradier Pro software, on this side of the graph, we have calls. On this side, we have puts. The market is at 227.07, and it highlights this inside the options grid. It highlights where the at the money option contract is at. We're looking at about a 1 standard deviation move right here. The delta is 18 down here. It's 13, so it's somewhere right in the middle here. And that is highlighted by the gray section inside the Tradier Pro software. So if I'm looking to do this trade, what I want to do is go about 5 points wide, hang right at that 1 standard deviation move, around 10 points down on the underlying stock. And if we go and we look at the chart, we're down right around this level, right where the underlying stock took off that breakout. So we can do it short term, and I don't even mind going out one more week if you want, but this is where I want to stick at for Options Guy TV right now. And we get a decent amount of premium. Implied volatility isn't bad. We are in December. We might get some sales news that comes out, but we're not really getting into the end of the year. There's still not a ton of there's no earnings reports, that type of things. But obviously we are in the holiday sales season. So I expect the strength to stay in Amazon. I think it might get just choppy through here. Want to sell a put, and I wouldn't even mind if the stock was put to me if you wanted some Amazon. I have long Amazon in a different account. So I don't want to buy any more at this point in time, but this isn't a bad way to look at it. I think selling a put would be a solid way if you wanted to purchase the stock, but I would move up and strike a little bit. Okay, so I digress. So here's going to be our paper trade for the next 11 days. December 20th, we got December 20th. So last week I screwed that up. Screwed up my expirations on one of my trades. Okay, -2. We're going to sell the 217.50 put, and we're going to buy the 212.50 put. And we can get that done for a net credit of 58 cents to the account. The delta is right around 18 or 19 in this position. So you have about, we'll call it a 19% chance of this underlying stock going below the current strike and finishing 1 cent in the money at expiration. It's only 11 days away. We're going to put it on for about 58 cents. If the market, if we can close it for 10 cents or 15 cents, we're going to get out of this trade. That's what we're looking to do on the short term. The market comes down to our short strike, we're probably going to get out of the trade. You could also say if the market starts trading for about $1, we'll probably get out of the trade. So that's just the way that we're going to manage it. Looking for a little bit of chop in Amazon here going forward. By the end of the week, hopefully by Friday, we'll be able to get out of the trade. The market stays where it's at. We get a little bit of time decay on Amazon, and that's going to be our official paper trade. Let me send this to the what if calculator so that I have it saved. And we'll take a quick peek at the profit and loss graph. So here's where we're at right now, 227 at this point in time. Here's where our short strike kicks in, 217.55. We have the risk of 5 points all the way to the downside. If we get this done for the net credit of 57 cents, we do have a fairly substantial amount of risk in that. We have a high probability of success, and that usually means you take on more risk. So we're 5 points wide, minus, we'll call it 60 cents, or $4.40 minus the net credit received. So we have $4.40 worth of risk, and we have 60 cents worth of upside, but we have a high probability of success based off of where the delta is at. And in the shorter term, it's going to be a little bit more, I don't know about accurate, I would say, but you have this is always, when we look at delta and we look at probabilities, that's the probability of the underlying stock by that expiration date, which is only 11 days away in this case. So, yeah, we really need Amazon to kind of stay where it's at or drift higher or just kind of chop right now at this point in time. And that's the trade that we're going to have on for this week. Now, the markets are still strong. I still feel very bullish about the SPX and everything. And we had a little bit of a pullback so far this morning. So right now we see the SPX at 6,059.37. We're down 30 points on it today, or almost 0.5%. We see the VIX jump up a little bit. And I did say that, I'm still looking to get long the VIX. If the VIX hangs around 13 level, and we'll have to look at the futures contracts, we'll probably at the end of the year or the beginning of January, think about getting long some VIX again. I just don't think it can stay down at this level for a while, and it has to do a little bit with the euphoria in the marketplace. But we were smart on Friday to not get long the market. Like I said on Friday's show, if I want to get bearish, I don't mind getting bearish going into the Monday or over the weekend. I don't mind doing a bearish trade over the weekend. Markets have a tendency to go down on Mondays, more so than any other day of the week. And I guess you can, I don't have any rationale behind that besides the fact that you have a weekend of news that the market has to digest before that Monday kickoff for the markets. So it's a little bit sketchy to put a long call spread on. I still want to be bullish going into the end of the year, but I think this is a healthy downturn, and I would rather do it a little bit closer to the close. Oh yeah, that was the wedge pattern that we had set up here. Did kind of break out of that. All right, so let's take a quick, let's zoom in here with what we have, and we can remove that, and we still are staying, yeah, a little bit choppy, a little bit nervous. We might pull back down to the 20-day moving average at this point in time. All right, let's flip the script. Let's do it. Let's do the put butterfly on this trade. And we can do it one of two ways. We could do the skip strike butterfly in the SPX, where we're trying to get it done for a net credit to the account, or my go-to, which is the modified butterfly, which if the market does pull down hard, and let's go back and look at that chart. So from here to here, we're going down in this range. If we do pull back down towards the 6,000 level, down 20-day moving average, let's look at it. Let's do it. So I think I want to kind of combine it here. We'll go, this expiration is on the 13th of December. We're at 660. One standard deviation move is down around 55.90. We'll go about 30 points out of the money. We're going to buy this one, sell 2 of these. And that's 10 points, 10 points, and then we're going to go down and buy the 6,000. It's 20 to 30, 30 to 10. That's way too. Four days away. Net debit of 1430. 4 days away. Let me try setting this up again. This is not 14. Okay, so we're here. I don't know what I have wrong with this. Okay, we're buying that one, paying 14 bucks for it. We're going to go down. Let's sell the, yeah, we'll do the 620. And we're going to sell 2 of these. And then we're going to skip the 610. We'll do the 6,000. And we are in this expiration. There it is. Okay. It makes a lot more sense. I have no idea what I had going on there, but I think my quotes were stale. So that's a 120 net credit to the account. So I'm going to send this to the what if calculator, and that makes a lot more sense. And we have 4 days until that expiration date. So I haven't done a skip strike butterfly in the SPX in quite some time. Let me zoom in a little bit here. I don't know why it was showing 14. I honestly was a little befuddled by that. Okay, so the market is right here at 60.62. 6,000 is where our maximum risk would kick in. We're going to go 10 points wide. So we do need a little bit of time to start with. This is not a bearish trade, but then as the week goes along, it's going to become a bearish trade. So we're kind of got a mixed outlook here. And that's kind of, I guess, the way I feel about the market right now, in that we are overall, I'm bullish on the market. I think we've had a big run up. We're going to get some chop. I was kind of hoping that chop would probably start in January, but right now we saw a pretty big run up in the VIX. We're down about a 0.5% in the SPX. Market is right here at 60.63. We are going to sell the skip strike butterfly. If the market goes on up, we can make $1.30 on this trade. We're going to have $1,000 worth of risk, and our risk is going to kick in on the strike that we'd skip, which is in this instance the 610, 6010, 6010. That's right where that break even is at, and that's right there. Okay, so it's right about where that the strike would be if we bought the standard butterfly. If we bought the standard butterfly right here would be the strike that we would buy, and that's where our risk kicks in. So what is a skip strike butterfly? I haven't done one in a while, especially in the SPX. We have done these trades around earnings. But if you look at a butterfly, you have normal wings, right? In that you pay a net debit for that butterfly. And you have very minimal risk because it's usually a small net debit relative to the upside potential of the butterfly, but it's got to stay within a range. By skipping the strike, which makes it a standard butterfly, you are actually embedding a short put spread to pay for the actual butterfly. So by skipping a strike, we can get it done for a net credit, but we bring in additional risk. And that additional risk is the short put spread. And that's the distance between the strike that we skipped, which is 610 and 6,000. So interesting trade. I think this kind of goes a little bit along better with my forecast for the week. I don't like that the market started down. I'm a little nervous that we might come back down and test that 20-day moving average. But if we can just hang out for a few days, we have the potential to make the $1.35 on the trade. And to start with, if we put this trade on and we ran right to our short strike of our skip strike butterfly, some people will call it a modified butterfly. Skip strike to me is the right term, mainly because you are legitly skipping a strike of a standard butterfly. And as expiration approaches, if we grab this graph and we move it forward a day, here's Monday, here comes Tuesday, and let's go all the way to Thursday, because we're not going to get a lot of decay until Thursday. As I've mentioned many times on this show, from Wednesday to Thursday is when the time decay starts happening. Watch the green line while we do this, okay? And then we go to Friday. Now it's kind of flattened out a little bit down this level. And we get to Friday, and then that's noon on Friday. And then from this point on Friday, well, 11 o'clock, 11 a.m. Eastern time. From this point on, now it has to match, start going towards our expiration graph right at the peak. So it takes some time for the premium to erode. If we do this trade, ideally we want the market to stay where it's at for a few days or drift even a little bit higher. And then ideally, which it doesn't necessarily matter when I say ideally, but I'd rather just make the premium from doing the skip strike butterfly, the $1.20, than have to worry about it. But if the market starts coming down this way on Thursday or Friday, ideally we land somewhere in the middle, and our maximum upside on the trade would be $1,000 plus the 120 that we put on the trade. So a lot of people will look at this trade and say it's an alternative to a butterfly, and I like to say it's an alternative to a short put spread. Because if I do the short put spread, getting some decent premium. We got a little bit of a run up in the, and I'm going to run back here. We got a little bit of run up in the VIX today. We're getting a little bit more juice out of the option contracts. So this is a short premium trade, and that's what we're doing. We're trying to capture some time premium. And as an alternative, if you just go and put on a short put spread where you're selling the 610 and buying the 6,000, if you just do that trade, well, and the market goes against you, you don't have any protection. I think of this skip strike butterfly as I'm already putting my hedge in. I'm already got my hedge. My hedge is this long put spread that will make me profitable if the market does actually come down towards my short strike of my short call spread. Now, the downside is, well, the upside and the downside. The upside is that if you're in the SPX, there's a lot of premium just because it's a very expensive index, and you can bring in a nice net credit to the account if you're doing this trade. Now, the downside is that it takes a while for that premium to start to decay, and usually you don't get some decent time decay in the SPX until Wednesday to Thursday, and then Thursday to Friday, and then it's like, wham, my sled hit the tree from Friday at noon going into the actual close. And that's going to be our paper trade for this week. Long and SPX skip strike butterfly. I was hoping to just get long the SPX, but I don't really like where the chart is at. And then we're also going to look at our Amazon short put vertical spread, and we will keep an eye on our BlackRock trade. That's a longer term trade overall, but we got to pay attention to where the market is at for our short call strike. All right. If you have any questions, please do put them in the chat box. And I don't see any today. I think I got all my expirations right on the show. I don't know why that was showing me such a huge net. I don't even know if it was a credit or debit to the account, but we got it all figured out. So thanks for coming in. Please follow me on x.com. My handle is @BrianOverby. We do stream this live every Monday, Tuesday, and Wednesday. Options Guide TV at 11 a.m. Eastern Time. Set up a profile in the hub, hub.tradier.com. You can ask questions via the hub, and you get access to all the great speakers inside the hub. So it's worth setting up the profile. It's all free. And lastly, you can follow us on the Tradier YouTube channel. If you are logged into the YouTube channel, you can ask questions via the YouTube chat box. Thanks for stopping in, and we'll see you Wednesday, and we'll see where our trade is at in the S&P 500 index.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.